Let's look ahead to the markets before the opening. Joining us right now to talk about is Jason Trennert, Strategas Research Partners Chairman. Good morning to you, Jason. A day ahead of this inauguration, how are you thinking about the markets and how are you thinking about what's to come, given the number of executive orders we're anticipating that we're going to be seeing over the next 10 days?
Well, I think, Andrew, my own particular feeling is that it's very hard to short this market. It's hard to get particularly pessimistic because of this tsunami of liquidity that we have. Money growth M2 is growing 25%, and also you're going to get a lot of spending. There's no two ways about that. Which you already have a lot of spending in the pipeline that will be used in the next 4 or 5 months, and then you're going to get an increase in that. But it's very hard to be short. By the same token, I think it's going to be hard to get big index returns this year, in my opinion, because long-term interest rates are likely to rise. And I think the way to play it largely is through, I think, as everyone's been saying, more of a value orientation, more of a sector rotation towards financials, energy, industrials. Those types of stocks, in my opinion, should do quite a bit better.
And so then the question, though, I think for some of the viewers, are you going to pick and choose individual stocks? Would you pick and choose individual industries, meaning would you just buy ETFs based on the 3 or 4 industries you just talked about, or how would you do it?
Andrew, we don't do that at our company. We have a technical analyst by the name of Chris Barone, who's very good at picking stocks from a technical point of view. I think this is, and I've said this for years, of course, and all of our clients are active managers. So, what else would I say? But I think that this will be a better time for active managers because the index returns are likely to be less. And picking individual stocks, I think, will be more fruitful than it has been in the past, where largely the major trends largely carry the day, where it could largely be overweight tech. It had to be overweight tech to have any chance of beating the market. I think this year is going to be a bit different. So I would, if I were one of your viewers, I would frankly, I know it sounds self-serving, but I think I would get some professional help because I do think the dispersions and returns will be greater than they have been in the past.
Would you meaningfully be underweight tech? Meaning, would you sell tech at this point? When you look at the Zooms of the worlds, some of the stocks and big high flyers that we've seen, do you say just overheated? A year from now, they're going to be worth more? They're going to be worth less?
Andrew, I'm too afraid. Listen, when you have this kind of meddling in the markets from the part of the Fed and by the federal government, I think it's too great to try to pick and choose when the peak will be. We've counted. I think there's about 13% of stocks in the Russell 3000 that are trading at more than 10 times sales. I can tell you with some certainty that those stocks will be lower, but I can't tell you when. And they could probably be a lot higher before this is all over. So I think there are parts of tech that are very overheated, no two ways about it. But I have no interest in fooling around with people that can print money. And as you know, the Fed's balance sheet has gone from $4 trillion to $7 trillion this year, just in a couple of months last year. And there's no sense that it's going to get any smaller anytime soon. So I'm not in. I want to be market weight tech if I'm being strategic about it. I don't want to be short.
Shepard Smith here. Thanks for watching CNBC on YouTube.